This is the Retirement Bullpen with Richard Warner. The team at Warner Financial Solutions want to help you feel confident about your retirement, no matter where you stand. Get more at warnerfinancialsolutions.com. Now, the Retirement Bullpen.
The Seahawks won their second Super Bowl back in February, but some players may be paying for it this April. Since the game was held in Santa Clara, California's 14.6% Jock tax applies to the bonuses. So that equates to $178,000 for Seahawks players and $103,000 for Patriots. Plus, they get taxed on every practice, meeting, and media day that they spent in the state. Seahawks quarterback Sam Darnold alone could face a $249,000 tax bill. That's enough to wipe out his winnings. So the question is, if elite athletes can be caught off guard by taxes, can the same happen to retirees? Stay tuned to find out. You're listening to the Retirement Bullpen. I'm here with our host, Richard Warner. Richard is an investment advisor representative, certified income professional, and owner of Warner Financial Solutions. You can learn more at warnerfinancialsolutions.com. Richard, did you watch the Super Bowl?
I actually did not watch a single play of the Super Bowl.
Really?
I had zero interest in that game this year. It's not completely unusable. There's got to be something that draws me into it. I like college football. I'm not a huge NFL fan. But
Sure.
I do watch the Super Bowl occasionally, but that game, for whatever reason, I had something else I needed to do, and it was just more important. So,
Fair enough. I think you were not alone in that. I'm not sure many people get too excited about seeing the Patriots back in, though I'm from New England, so I tuned in just simply because it was the Patriots, though I hadn't been following them very closely this season. And my husband and I enjoy the commercials, so usually we tune in for that. But I didn't think they were that great this year.
Can't comment. Didn't see any. So
Can't comment. You didn't see them.
Nothing.
I'll make you feel better. You didn't miss much. Let's put it that way.
Sounds good.
But that said, I think it's surprising to learn how much these players will lose of their winnings simply to taxes. I had no idea when I was doing the research for this topic that they lose that amount of money on this so-called Jock tax. What are some surprises that retirees run into when they hit retirement that may catch them off guard?
Wow, that can be a lot of things. I'm going to kind of stay focused on the most basic things that will affect potentially any retiree, at least any retiree that has more than Social Security. So let's start with your retirement accounts. Most people understand that when they're working, they're going to pay taxes on their income. Most people understand that when they are accumulating money and it's taken off their taxes, such as a 401k, that someday they're going to pull that money out and they're going to pay taxes on it as they pull it out. What they don't always understand is how some of these things work together in retirement to create sometimes some pretty big tax bills that are a little bit of a surprise. So for example, let's say you take a married couple who is both drawing Social Security, and that's all they have. In rural Nebraska, I run into that from time to time, and they can live comfortably at that because cost of living is low here. Maybe they just have no bills of any sort from debt, so they can live off that. But let's say they have a modest amount of money in an IRA that they've rolled over, and they just have never needed it, so they haven't taken out of it. And now they hit the age of 73 this year, and they are taking a required minimum distribution this year, which wouldn't affect them this year. It'll affect them when they do their taxes next year. But prior to that required minimum distribution, if they didn't have any other income, they're not paying any income or state tax on that Social Security. Okay? So it's all tax-free. So they could have $3,000 or $4,000 a month coming in very easily that, almost $50,000 of income, or even in some scenarios, a little over $50,000 of income that does not get taxed. Mm-hmm. And then they have a required minimum distribution. So this is amount as you get older that you have to begin taking out of pre-tax accounts. So a 401k, a 403b, an IRA, something that has never been taxed has to come out. It's based on how much money you have in those accounts. So if you have to start taking that money out, it's never been taxed before. It is added into this equation that is called provisional income that determines, is your Social Security taxable? And if so, how much of it? So there's different brackets to that. And what happens is people get a surprise. They understand that that portion coming out of the IRA is never been taxed, that they need to pay taxes on it. They account for that. But they don't realize that now maybe half their Social Security, or now maybe 85% of their Social Security is now also added into their taxable income. And they've never been withholding on that. And so they get a surprise bill, which can be very substantial in some situations. So that's a really, really big one that pretty much affects most retirees. I'll give you a surprise example in there. So I won't use names, but I knew some folks that they did not have this understanding, and they wanted to pay their mortgage off at retirement. And that mortgage was about a $150,000 bill. And typically, a good rule of thought, you're going to hear people on the radio saying, yeah, you want to get debt-free, debt-free, debt-free. It doesn't matter what the cost. You want to get debt-free because of all kinds of different reasons. And I tend to agree, debt-free is good in retirement. However, you don't want to get debt-free at a higher cost than just paying the interest, specifically a significantly higher cost. And a lot of people don't understand that. So these folks pulled this $150,000 or so out of a 401k when they retired, understanding that they're going to need to withhold, 20%, 15 for federal, 5% for state, roughly on that. But they had no idea what that would do to, number one, Social Security taxation. Now, instead of their Social Security being tax-free, it's in the 85% bracket, which means 85% of their Social Security is taxable.
Wow.
Not an 85% rate, whatever their rate is, but it's, so if they have
85% of what you earned.
Right. If they have a $1,000 check, $850 of it's taxable, $150 of it's tax-free. That gets added onto the $150,000 taxable income out of the 401k, creating a higher tax bill on the 401k potentially, could jump them to the next bracket. But it also does something else they didn't predict, which cost them almost 5 figures in extra costs, which was, well, between everything, it cost them about 5 figures, but it's increasing their Medicare Part B premium. In that scenario, it doubled it for each of them.
Oh my goodness.
It also increased their Medicare Part D premium. So again, it's a surprise tax based on their overall income. And a lot of people don't understand how these things work.
When you have a tax event, such as the one that you're just explaining, and it bumps up the cost of their Medicare premium, how long does that stay in effect? Is it just bumped up for that year, or is it indefinite from that point forward?
It should just last for that year. But here's something they also found out, which I'll be honest, before this, I didn't know this either until they told me what they had to do, because I assumed that it's just going to shut off when the new year comes, that the government's going to do their due diligence and they're going to charge according to the actual income. They don't double check. They assume your income's going to stay that way. You have to prove otherwise. Wow. So they actually had to go back and file paperwork with the Social Security to prove that their income had reduced, that this was a one-time occurrence, which then lowered back to the original amount. But they didn't find that out till they started filing and found out, whoa, we've got this bigger Medicare premium. Our income wasn't that high. Why did it not go back? And so they started doing some research and making some phone calls, and they found all this out. So yes, it does go back, but you have to prove that it did go back to that regular income.
You can correct me if I'm wrong on this, but in the years leading up to when you start taking Medicare for the first time, they look back 2 years. So it's not just a 1 year look back. They're looking back at 2 years. So if you were to do this at 63, the scenario that you're talking about, and you're taking a lump sum of money to pay a debt, that would be factored into what your Medicare premiums would be, even if it was 2 years back.
It will be for that first year. And then again, you've got to prove that it's not. But after that first year, you'd be okay. But yes, so you can have bigger costs than you would expect based on taking too large of distributions. So it's something you have to be careful about. That's a huge surprise tax.
Talk to me a little bit about what tax planning and active tax planning looks like. What questions should retirees be asking their financial advisor in the years leading up to retirement? How early do you like to have this conversation with a retiree to make sure that they have a plan in place and they're not caught off guard by the scenarios that you're talking about?
I think an ideal time to start this is about 5 years out, but some people it could be more, depending upon really how much projected pre-tax money you're going to have. along with your other income when you do retire. Primarily because a lot of people, I think, have a hard time grasping what their accounts are going to be valued at, not necessarily when they retire, but when they have to take RMD. So today, the RMD age for most people that are retiring is now 75. There's still some of that 73, but if you're born 1960 or later, you don't have to take it till you're 75. So you are, let's just say you're a 65-year-old and you don't have to take your RMD for 10 years and you have $1 million in your IRA account. Well, if you don't add any more to that and just get a moderate rate of return, you're going to double that, probably more than double that by the time you're 75.
Wow.
So they assume I'm going to have this amount that I have to take out based on the number now. Well, it's going to be twice that much 10 years from now. What will that do to your tax bracket? So then if we start planning this 5 years in advance, so let's say we start talking to this individual at 60, the biggest thing we can look at that point is, could we utilize Roth conversions to reduce that tax bill later on? So there's pros and cons to doing that. Roth conversions require taking money that's never been taxed, making it taxable, and put it into a tax-free account. At least the account will grow tax-deferred and come out tax-free as long as you've had it for 5 years. So a lot of folks, if they start early, can benefit from this. It depends upon your overall income, what your projected tax bracket's going to be in retirement, what your spending needs are going to be in retirement. There's a lot of factors that are involved. I run into a lot of people that they're going to just use a portion of their IRA each year in retirement. And at some point, those RMDs are going to be dramatically more than they want to take out, and that required amount. And so by starting this program of converting some of that money over early, they reduce that required amount down the road. Plus, they also create an account that if a surprise comes up in retirement, they can draw from the Roth account that doesn't affect their Social Security, that doesn't affect their Medicare, and they can draw from that to pay that surprise expense. And if they're going to leave an asset behind, which a lot of people with a lot of money do end up leaving some assets behind, they don't end up spending it all. A Roth is a whole lot better for your kids to receive because they don't pay any income taxes than a pre-tax. But again, you don't necessarily want to plan for your kids. Some people do, but most people want to make sure they're taken care of first.
Sure.
But the end goal is, let's help you and your household and your heirs keep as much of the money as possible versus Uncle Sam.
When you're sitting down and having that initial conversation, how do you weigh out the priority that various things get? As you mentioned, we hear on the radio, certain people always tout you need to pay off debt. So if you're sitting down with a couple and they're saying, oh, I have this $100,000, how do you weigh out whether it's more beneficial to do a Roth conversion with it or pay off debt? What does that conversation look like?
That conversation is going to start off with priorities of the individual and the couple. Okay, what is their end goal? Okay. Some people just like to get rid of debt. So if you can be strategic about it, even with pre-tax money, if you can spread it out over years to accelerate it, that can be beneficial versus taking a lump sum and doing it. The other thing is, if they have a lot of money sitting in non-qualified accounts. So what is a non-qualified account? Could be a savings account, could be a CD. Stock accounts sometimes don't work well because to liquidate them, you can create capital gains, and that can create other effects on your tax. They can work in some situations, but you have to be a little more strategic with that as well. Typically, money in bank accounts is just getting taxed year after year, so you're paying the tax bill as you go. So if you took $100,000 out of a savings account, for example, you're not going to create any new taxes, and you're probably going to win long-term paying that debt off of that money. Now, the other side of that, though, is you could use that $100,000 to help pay the tax bill of Roth conversions, which could accelerate the amount you get into a Roth IRA down the road. And here's what I mean. When you do a Roth conversion, people take money from pre-tax. Typically, they don't have the funds or the income to pay the tax on the conversion. So they have the converted amount pay the tax. Okay. So if you're converting 100,000, they may take 25,000 off the top, send it to the IRS, and convert the other 75,000 into the Roth. Ideally, if you can pay the tax bill, now you convert the whole amount, which turns your return on investment much higher, much more quickly, meaning you get more bang for your buck out of that money by doing it that way. Typically with debt, though, it's probably better to get rid of the debt than go that way, but it depends upon the numbers and what we're projecting down the line. And quite honestly, How expensive the debt too is a factor. So let's say they have an old mortgage that was done before 2020 when interest rates went up and they have 2.5% rate of interest and they're in the last half of that mortgage.
Sure.
Well, they probably have almost no interest left in there. They're not saving much of anything by paying that debt off. So why do it? So there's a lot of factors that can go into it. And these are all things that people need to consider where they're in the process, what they have in cash reserve, what it's going to create their tax bill now, what it's going to do for their tax bill later on. Again, the end goal in everything we do with helping people transition into retirement is keep as much money as possible, whether it's from market losses or from the IRS. Keep as much money as you possibly can, because the more you keep, the more you're going to have to spend and enjoy in retirement.
Well, as we've heard, taxes don't stop at retirement. They just change. And we certainly don't want to be caught off guard. If you want to be proactive instead of reactive, now is the time to connect with Richard and make sure your retirement tax strategy is working for you, not against you. And to do so, you can reach out and schedule a complimentary consultation by visiting warnerfinancialsolutions.com. And of course, be sure to subscribe wherever you're currently listening so that you never miss an episode. And if you found this helpful, of course, we would love it if you shared it with a friend. Thanks so much for joining us. We'll see you next time.
Insurance products are offered through the insurance business Warner Financial. Warner Financial is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Warner Financial are not subject to investment advisor requirements. NPN number 7617022. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Warner Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Warner Financial.